Everybody, it's 1 o'clock, so we'll kick it off. Thank you all for coming in. I know insurance is not the sexiest topic, but at least it's cyber insurance, so it's a little bit more exciting. We just want to give you a little bit of background what Markel is. Markel is an insurance company that is headquartered in Richmond, well, right outside of Richmond, Glen Allen. My name is Kara Owens, and this is my colleague Lou Botticelli. We're both on the cyber insurance team for Markel Corporation. We are from New York, so you'll be able to tell that by Lou's accent, and if you get a couple drinks in me, then you'll be able to tell by my accent. So really the few areas that we want to cover today is to make sure we walk everybody through what a cyber insurance policy entails, what the process is of purchasing a cyber insurance policy, what we're seeing in the cyber marketplace, some of the claims trends that we're seeing, which will be very familiar to everybody in the room, and then where your traditional insurance policies, such as property or casualty, general liability, if you're purchasing them, where they might fall short from a cyber coverage perspective and where there could be gaps there. And then lastly, some emerging issues. So if anybody has any questions throughout, please feel free to ask. We'll also do a Q&A at the end. Just for a show of hands, how many people in the audience actually buy a cyber insurance policy for your company? All right, there's a few. We also have some Markel people here. We do buy a cyber insurance policy. We don't buy enough limits, but we can go on that one on a separate time. So with that, I'll pass it over to Lou, who will walk us through what a cyber policy entails, what coverages are there, and what we're seeing, and how this is developing, and then also the process of purchasing a cyber insurance policy.
Okay, good afternoon, everyone. So as Kara mentioned, a cyber event could touch and impact many different types of insurance. So I'm going to go through just a standalone cyber policy. Like, I'm buying this policy just for a cyber event. So a standard standalone cyber policy, we break it out normally into two different coverage parts. Right? You have your first party coverage part and your third party coverage part. Right? Your first party coverage part is basically when an event happens and the immediate expenses that you sustain that you have to pay out, either would it be breach response or some sort of business interruption issue where your network goes down and you need someone to come in and run some forensics, et cetera, to figure out what the issue was. That's your first party coverage. Your third party coverage is usually those claims that come in the door, those lawsuits that you are sued by a client, you're sued by someone, or you have a regulatory issue, GDPR, something of that nature, that you have a fine or a penalty. The policy will kick in and pay for those as well. I try to simplify some of this sometimes because even people who work for me have a tough time with it. If you relate it to flood insurance, right? So let's say you're the owner of the house, that's the first party coverage, you have a flood, you have damage, this policy will kick in and will pay those damages, those expenses related to that. You have a house, you are either the architect or a contractor or some sort of builder, and your error caused the flood. There was some mistake that you made that caused the water to come in and cause damage. This policy will cover you as the architect or the builder, because you're going to get sued for the error that you made. Just to give you a few examples here, under the first party coverage, business interruption, that's your DDoS, that's your NotPetya, that's your WannaCry. We all know, obviously you've heard of those. These are covered, this is the coverage part that was triggered when those happened, and those that did have the coverage, these policies paid out. You have the contingent business interruption that has been more prominent in these policies over the last couple of years. That's an issue, an event with one of your vendors, one of your providers. Whether, a good example, what we always use is AWS. If AWS were to go down and you have this coverage and you have contingent business interruption in your policy, this policy will pay your expenses. We have the data, I'm sorry. No? Okay. We have the data pre-event and post-event response. We're going to hit that in a couple of slides later, but just give you an idea. We negotiate contracts with vendors, and we use pre-event, we use post-event. Obviously, everyone knows the post-event. When you have an event, you're able to call a phone number and you're able to get in touch with a breach coach, forensics, etc. The pre-event is also something that we do a lot of work on, where we negotiate rates with different vendors. So to help you as a Markel insured with incident response or access management or tabletop exercises, whatever it may be. I'm going to lump the next two together, data recovery and cyber extortion. It's your ransomware. This policy will cover the expenses associated with maybe paying a Bitcoin ransom, as well as if you lose that data, recovering that data. And system failure. So that's similar to business interruption because system failure is a business interruption. It's the slight difference in that the two I spoke about earlier, those have to be caused by a security breach. Whereas system failure, basically the system just has to go down. That's a newer coverage that has come in probably more prominently over the last year and a half or so. And it's something that we have to monitor pretty closely because that is something that is a systemic event for us. But again, business interruption and system failure, pretty much the same thing. One has to be security breach, the other one just has to, the system has to go down. And media, there's an aspect of media coverage where if you do have the breach or an event and you need a PR firm or a crisis management firm, we pay for those expenses as well.
So an example of the system failure would be like something like Delta or Southwest. We've seen a lot of airlines that have suffered system failure, and insurance has paid out on a lot of that.
And your third-party coverages I spoke about earlier. Everyone knows GDPR. California's coming out with their own regulations shortly. There's talk of federal, nationwide privacy regulation. Those issues will be covered under the third-party coverage section, under the fines and regulatory costs. Another aspect of it is, everyone knows Target and Home Depot, Anthem, whatever it may be. Specifically Target and Home Depot, where there were credit cards involved, you had to issue those cards, and that was through the banks. That was a cost for the banks. The banks don't want to take that hit, so what do? They then sue you as Target or Home Depot. And there's coverage for that under this policy as well. Some coverage trends that we're seeing over the last year or so, 6 months to a year. Traditional BIPD, product liability. Example is autonomous cars. You know who those makers of those cars are, as well as pacemakers that are connected to the internet. If there is a cyber breach and it causes something of an event, whatever it may be, and someone dies, this is covered under this policy. Preventative shutdown and betterment. Let's say you're in a scenario where you either know of something that is happening, an event, or something that might happen, and you preventatively shut down your system because it would have been worse if you let it go on. That's covered under this policy. The betterment piece is once that is shut down, you can come to us and say, hey, listen, we don't think that restoring the system the way it was is going to do anything but cause the same issue. We need to improve on what we found the issue to be. We'll have a discussion, but most likely that's also going to be covered. We have social engineering. Everybody knows what phishing is, and you see it all the time. It's one of the probably number one claims that we do see, where somebody gets an email asking for $100,000 or $500,000 as a vendor. They send it off. It's over. $500,000 gone. You post a claim to us. That's covered as well. And then reputational harm and business income. This is an issue where you do have that business interruption event or the data breach, and you have the hit to your reputation, just like it says. You lose clients, you lose income over a period of time, $1 million, $2 million, $3 million, whatever it may be. there could be coverage under this policy for that.
And just one important thing to note about the coverages on the previous slide as well as the coverage trends, every cyber insurance policy is different. So unlike what you might see with your homeowner's policy or property policy or something like that, there's a lot of standardization there. You don't have that yet within the cyber insurance space, so you just have to make sure as you, and we will go through the process, but as you engage with the broker who's placing the policy for you, that you try to negotiate what coverages you think you need, especially for these coverage trends. These are not commonplace. These are just some of the things that we're starting to be requested within the marketplace.
Thank you. And as I mentioned before, the pre-event and post-event services, if you are, in our case, a Markel insured, or AIG, whoever it may be, Chubb, they have similar offerings. We've done a lot of work because we think that pre-event, similar to what the healthcare industry figured out probably 10, 15 years ago, let's stop paying for all this once everyone actually gets sick. Let's figure out a way to preventive medicine. Let's pay for your yearly checkup. Let's pay for you to go and get preventative health care and pay less money there as opposed to on the back end. So that's something that we thought was a fantastic use of resources, fantastic use of time for us to go out there and partner not only with these vendors, but then have a relationship with the insured, the vendors, and us, because we're all, a healthier client's a healthier book of business for us. And for those that don't have the insurance, a little blurb here on how it actually goes down. From someone who had no clue what insurance was before he got into it. I used to be a private investigator, and I found an ad for AIG in the paper, and I was like, nothing could be safer and more far removed from private investigation. I sit at a desk doing insurance for 7 hours a day. So, from someone who was an underwriter, became a broker, and is back to being an underwriter, I have a good view on how the whole process works and how that goes down. So. The distribution process, you are a client, you need insurance, what do? You go to a broker. A lot of the larger brokers out there, names you might know, Marsh, Aon, Willis, Lockton, McGriff, et cetera, et cetera, et cetera. You go to them and you sit down, you have a meeting with them, and they go over your operations. What do you need to be covered? How do you need to be covered? It could be any, if you're in the healthcare industry, it's totally different than you're a manufacturer, right? There's different things you need within the policy to make it work for you. Once they have a handle on what you are and what you're doing, they then ask you for some information, whether it be an application, some sort of cyber security assessment that each one of those top brokers that I mentioned has their own little either Excel spreadsheet or some sort of portal. And once they have that information, they go to the market, Markel, AIG, Beasley, Chubb, et cetera. And they bid out your insurance, right? Depending on how much you need, what you need, terms and conditions, et cetera, they'll go out and get these bids, and they'll come back and present to you. Now, throughout that process, there's a lot of dialogue going back and forth as well. Best case scenario for us, as the underwriters, as the insurance carrier, you also have maybe a meeting or a conference call, which is much more beneficial to everyone, I'll tell you that. It's a lot easier to sit down for an hour, hour and a half, 2 hours at the most, have a dialogue back and forth regarding everything, incident response, access management, business continuity, et cetera, et cetera, et cetera. And then once we go back after the meeting, we have discussions internally and give you our best efforts. So this, inclusive of what that whole process was about, right? You get all this information. Risk management, privacy, data, and network security, we all put that into a nice little worksheet. We talk, like I said, we talk about it internally. We figure out what kind of terms and conditions we want to offer, how much it's going to cost. We then give the presentation to the client, to the broker, and then the broker will give it to you, and then it's time for you to make your decision. How much you want, what kind of coverage you need. Should I buy 10 more million in insurance? Should I buy a little bit more reputational harm insurance? Do I now have PCI exposure when I didn't have it before? I need that in my policy. So it's a constant process. It's usually 1-year policy, so every year you should hear from your broker a little bit more regularly, maybe every 6 months or something, just kind of check in and see what's going on. The purchasing and how much limits should you buy? Now, this is from March of 2018 Trends report. Again, I used to work there, so I have an idea of where this comes from. There's a portal that they have based on their clients that gives them an idea based on industry class and revenue size, kind of a reasonable idea of how much you should be buying. You throw in a little, just market intelligence that they do have as well, and you come up with this. This is something you would see most likely if you go to your broker and they give you an idea of how much you should be purchasing. And if you see, you could probably see it, right? So 17's on the bottom, 18 is on the top. These trends are all going up, and Kara's going to get into it a little bit more of why that is. But just to give you some quick points, we mentioned earlier, a lot of regulation, right? That's covered. So the more you're going to pay there, why don't you buy some insurance for it? Board of directors, that's their #1 issue from what we're hearing when we do surveys with boards. That's cybersecurity is the #1 issue on their minds. We have clients who will call you and say, how much cybersecurity do you purchase? If it's not enough, you better be buying more, because I'm sure that contract is probably more than the 10 million or 20 million more that you'd be purchasing in insurance. I don't know if there's any questions on that, but I'll let Kara take over from there. She's going to elaborate a little bit more on the buying trends in the marketplace.
Question?
So you're covering a third of revenue. That seems like a lot.
A third of all the revenue out there?
Like, why so much? Like, are you covering reputational risk? And is there really an impact to companies over $1 billion?
So
Significant like that?
So right now what we see, and the reputational harm is not, it's a pretty fairly new coverage, and if you think about it, it's really hard from like a forensic accounting standpoint to really try to calculate what that business, what the reputational harm was actually, and we've tried to do where we relate to, okay, if it's a publicly traded company and there was a stock drop, but there really hasn't been significant trends. So if you see all of these public companies that have had breaches, I mean, sometimes their stocks stay the same, sometimes it goes up, sometimes it goes down, and you also have to see what's going on with the stock market at the same time, because sometimes these might be going down, the whole stock market's going down. So the reputational harm business income is not that big of a piece of the market yet from a premium perspective. A lot of it, before you really saw the bigger buyers purchasing it really made up most of this, and what the payouts that we've really seen originally was from the breach notification piece. So like Target, as Lou mentioned, was a great example where Target had whatever it was, $40 million cards impacted. They had to reissue all the cards, they had to send out all the notifications. They had only purchased $100 million in cyber insurance, and that alone just got wiped out from the first party cost before even those banks came in and sued Target to recover for the third party fees. So you're starting to see companies buy more and more limit over time, because you've seen a number of these examples, like Home Depot's tower is exhausted, Anthem's tower is exhausted. So that's one of the reasons why you're starting to see these companies purchase more limits. But the reputational harm piece is still just really a fraction of it, and we haven't really seen any cases to show what exactly is going on there.
And I think you mentioned Anthem, right? So Anthem, their tower was exhausted, but they just had to fine not that long ago.
Tower insurance is, so say Target buys $100 million in limit. Usually it's kind of like, and mortgage-backed security is always a bad example to go to given what has happened in the economy, but it's always in tranches. So like $100 million in limit could be broken up by 10 different insurance companies. So you have the primary 10 million. So if Target had only suffered $5 million in loss, it would only be that one company that's the primary carrier paying out. But if they suffer that whole $100 million, you're having all 10 of those carriers pay out.
And that's the tower.
So that's what's called the tower of insurance.
Start at the bottom and all those payouts.
Exactly. So now that, Target suffered a lot more economic damages than just $100 million. And same thing with a number of these companies that suffered either big breaches or huge business interruption, like Merck and Maersk from NotPetya. Now they're realizing, oh crap, we need way more limits in insurance than what we're currently buying. So that really jumps into like some of these slides here is how all the industries and the limits that are being bought, what does that mean for within the insurance world? Right now it's about $3.5 to $4.5 billion in premium, which doesn't seem like a ton if you're comparing it to property insurance, but when you look at it, it's one of the biggest growth lines within the insurance industry, and it's estimated to be about $20 billion by 2025. So a lot of growth. And there's a number of reasons for that, which we've covered some of them already, but before, say, or go back in time, rewind 5-10 years ago, you really just had financial institutions, healthcare companies, retail companies buying because of the sensitivity of the data, or they had industry regulations that really required them to buy. Now you're starting to see manufacturing, you're starting to see hospitality, gaming, education. So this chart on the bottom here, you can see that over time, most of these are going up. And so now you don't just have those really highly sensitive data points where it's just really breach notification. Now you're really moving into that business interruption space too, because manufacturing's now realizing, oh, well, it doesn't matter if we don't have that many records on board, we can still suffer serious business interruption if our operations are somehow implicated by some sort of cyber attack. Also, another reason why it's growing is it's not just these larger Fortune 500 companies that were originally buying. Now you're having buyers across the board. So it's big companies, it's mid-sized companies, it's small companies. And Lou had mentioned before that now sometimes you're obligated as a smaller company to buy your own cyber insurance policy, similar to what you might be for buying an errors and emissions policy, where you have somebody like a Markel Corporation or another Fortune 500 company where they're saying, okay, in order for you to be a vendor and part of our supply chain, you need to buy your own cyber insurance policy, so that way if you suffer some sort of attack, the liability goes on you and not on us. So that's also created a lot of demand within that small business space for them to realize, okay, well, we're obligated to buy this policy.
Yeah, and also, again, being a broker previously and being privy to a lot of those conversations, one of my clients had said to me, I'm buying all this insurance because it's easier to say I spent, $1 million on whatever it was, so let's call it $50 million in insurance, than tell whoever I report to that we had this loss that could have been covered and we lost $50 million instead of $1 million.
Yeah, and it was a struggle for years to really educate the buyers as to why you want to buy, because you'd see some like CTOs or CISOs say, wait, like that means we're trying to get approval for this extra monetary spend on a cyber insurance policy. That means we're not doing our own jobs. And I think now everybody realizes, like, there's no preventing, like, the attack's going to happen. So how do we go back and defend to it? And you're starting to see the directors and officers, the liability going on them. So some of these, and some of this still goes back to public companies, but also you're seeing regulations across the board that could also impact not public companies as well, some private companies, where you saw some directors and officers actually fired after a breach because they said, listen, well, you didn't show that you took your due diligence as an officer or as a director to protect your consumers, to protect your employees, to protect your shareholders, and you can't prove this. And we saw this a few times. So there's cases that have been denied in courts, like Wyndham, when they had their big hack. They proved that, okay, we met on this a lot of times as DNOs to talk about cybersecurity before the whole breach occurred and then afterwards. But one big way to prove that we're thinking about this is actually buying a cyber insurance policy. So the companies now have to disclose in some of their 10Ks whether they're actually buying and what they're trying to do to protect themselves. So that's another reason why DNOs are saying, wow, like we really need to think about this. And another example, that's a good example, is Yahoo and Verizon. So Yahoo, they had those huge, massive breaches that came out years after the fact, but they were in the process of being purchased by Verizon. And Verizon's like, oh, wow, you had these skeletons in your closet that we didn't know about, and now, like, we're going to have to pay out a lot, and we're going to have to face all these lawsuits because of it, so we're cutting your share price by $350 million. So that went back on the directors and officers of Yahoo, and the insurance policy, the directors and officers insurance policy actually paid out. So definitely top of mind for these DNOs, and when the DNOs are thinking about it, then suddenly their purse strings loosen up a little bit when the chief risk officer or CTO or CISO comes and says, oh, that'd be great if we could buy a little bit extra security by having a cyber insurance policy. Also, Lou alluded to, there's a lot of regulatory requirements going on. It's a very evolving world out there between GDPR, all the 50 different state laws, the new California law coming up, all the various industry regulations for PCI or healthcare, finance, there's a ton of regulations, and then Singapore, Japan, I mean, you name it, there's all these countries are starting to have similar laws to what you've been seeing in the United States. So that's really driving some of the demand to purchase a cyber insurance policy too. And then the increased limits that we talked about before. So companies just realized they weren't buying enough and they were suffering more economic damages than what the insurance was covering. And if they would have bought more, then the insurance would have paid for it. And then also, we've seen a number of cases that are out there where the company didn't buy a cyber insurance policy and they tried to go to their property insurance carrier or casualty or some other traditional line to recover, and they realized, oh, we might not, there's not definite clear-cut coverage in here. So brokers are realizing and insurers are realizing, oh, well, there's gaps within those traditional policies. Maybe we should be thinking about buying a separate policy that we know there's affirmative coverage within there. So far, the insurance industry, first, oh, it's a question?
Yeah, so just confirm on here you say, because traditionally, we'll go to like XYZ vendor, one of the requirements of working with them is that they have cyber insurance. So we'll say, okay, we have $10 million cyber insurance coverage. If what I'm hearing you say correctly is that, just like any other insurance, there are different aspects of that policy that you buy. And so if you suffer a breach in this category, it may not be covered. And furthermore, I'm just confirming what I'm hearing you say, is that coverage within those categories may vary too. So if they have a $10 million policy, but may not have anything for some breach, but then it may have $5 million for some other type of thing. Is that correct?
Yeah, so
that's I'm sorry.
Oh, you're good. You're good.
So therefore, it's not enough probably just to say how much do you have at face value, right?
If you're asking the vendor, you say.
Yeah.
Right. So yeah, I mean, if you should technically dig into the policy, ask for the policy, and have someone in your risk management department or someone who, or even sometimes, I don't know how it will work, but we used to consult as a broker and look at some of those contracts, look at some of those insurance policies, and give an idea of what's in there, how much coverage is really applicable, and give you a good idea of the efficacy of that policy.
Yeah, and then sometimes you have the companies that are working with the vendors saying, okay, you need whatever, make up a $10 million in limit, and you need these coverages. So they'll establish some sort of guidelines or protocols as to you need these specific coverages in place so that we think we're sufficiently not taking on your liability. But so far the industry has been profitable. Obviously everything is incredibly evolving and there's not a lot of actuarial data out there, but we are paying claims. And this is a perfect slide to show you where, I mean, everyone's heard of every single thing on this slide, and insurance has paid out on the majority of what you're seeing. So, I mean, attacks on public entities, what's going on in Baltimore right now, we've seen payouts from the insurance industry on like Atlanta, we saw BART in San Fran where there's been payouts. Cryptocurrency exchange is a huge one. You see some carriers that have an appetite for that, some are that'll just stay away from it because it's just so evolving and there's not a lot of regulation around it at this point. Marriott was a huge one that was out there that had, I think, $500 million in insurance. That's going to be toast probably. And then we already talked about Verizon, Yahoo, and then NotPetya. And NotPetya, I mean, thousands of companies were impacted, a lot of larger companies, and the insurance industry paid out a lot of money. So really drilling into NotPetya more, this is an older slide too. So you see some of these numbers are already pretty sizable, and the insurance industry paid out hundreds of millions of dollars. But let's focus in on that pharmaceutical one, that $620 million. So that is referencing Merck, and that number would be even higher. And all of this is publicly out there, so I'm not saying anything that's confidential here. But they bought a cyber insurance policy, but again, this is another example similar to Target, where they had only bought $250 million in cyber insurance coverage. That got wiped out. And then so they're saying, oh, well, we have a lot of economic damages still. Let's try to go and recover from our property insurance policy. So that's where we're getting into what's called silent cyber. So silent cyber is if you see like a traditional insurance policy, like property policy, I mean, those policies would have been written years and years and years ago before the internet even existed, so they wouldn't necessarily contemplate the cyber exposure that's out there today. So the policies aren't excluding cyber risk, but they're also not saying, okay, well, this is definitely in here, that I'm affirmatively covering it. So that's what the insurance industry is now referring to as silent cyber risk. So the insurance industry is taking a look at all of these traditional policies to see how do we address this, because now there's $1 billion claim into the property insurance market for Merck, and we're seeing the same thing with Maersk, the big shipping company. We're seeing it with Mondelez, the company that owns Nestle. All of these are really stemming from not NotPetya, but we've seen some other losses that are hitting these traditional policies because of cyber attacks. So the industry is really trying to figure out where we stand on how do we address this, and that's why you're starting to see a lot of the coverage get kicked out and pushed into its own insurance policy. And I don't think we mentioned, but the cyber insurance policies are fairly new. I mean, they really go back to the late 90s, which doesn't sound new, but that's very new for an archaic industry like insurance. So we're all still trying to work through everything. And the ones that I had mentioned, the Merck and Mondelez is an interesting one because that's a big case that's out there where both of them are claims on the property policy, and Zurich is trying to use what's called the war exclusion because the UK and US attributed the NotPetya attack to Russia. So now they're trying to push out that claim. So we'll see what happens there. But bottom line is really that there's just so many gray areas, and the case law has been all over the place within these traditional policy that there's a lot of gaps there. And not just thinking about like NotPetya that can cause business interruption and ransomware and yada yada yada. There's a lot of other scenarios that are out there. So up here is just a really good example of a number of those exposures, and we'll go through some of those scenarios so you can get a sense of what the insurance industry is thinking about and where claims could end up and where the gray areas might be. So let's talk about property first. So property, if you think about Stuxnet, where the US and Israel work together to attack Iranian centrifuges using malware that actually caused physical damage. We've seen that actually replicated out there, and insurance has paid out on it in the property arena. There was a German steel factory a few years ago that actually there's physical damage caused because of the Stuxnet type malware, and the insurance industry ended up paying out on a property policy. So that's just one example that we're thinking about. Another one, intellectual property, which is rarely actually covered within insurance, but it's a very unique niche kind of product line. An example of that is when you saw Game of Thrones, some of those episodes were hacked into and released, and I mean, I'm going to blame HBO now because that last finale was so shitty that they deserved that. But that's just another example where we're just not talking about breaches that could impact the whole insurance industry, but we're talking about some other funky kind of attacks. Recall's another one. If Lou talked a little bit about autonomous vehicles or just really internet-connected vehicles, we saw a few years back when that white hat hacker hacked into the Jeep just driving to the side of the road to prove that the automobile industry really needs to up its game from a security and privacy perspective. You then saw a big recall of the Jeep. Well, Chrysler's Fiat that owns Jeep had to do a massive recall for that. So there's just all these sorts of different scenarios that are out there that we need to think about that aren't just breach related. And everybody in the room who owns a company or who's in charge of buying a cyber insurance policy also needs to think of these scenarios and say, okay, well, if some of these scenarios that used to be thought about in movies that are real life scenarios now, like if they occur, are we covered by one of our policies? Because you don't want to pay out of your pocket for all of this. There was one other one I wanted to go. From an emergent. And so besides these scenarios, and we'll get into some other scenarios we're thinking about, what are some of the emerging issues that we look at? One, critical infrastructure. I mean, when you're looking at transportation or dams getting hacked into, those are just a few very scary ones. Cyber terrorism, which can go hand in hand with the critical infrastructure, but think about medical devices getting hacked for a political figure or something like that, which is a homeland. There was an episode of Homeland on that, but that could happen in real life today.
I watch a lot of TV.
I watch a lot. Criminal Minds is my big one. I just got hooked on that. But political hacking, if you think about Russia, crypto we already talked about a little bit. Supply chain risk, we can go back to NotPetya for that one too, where you have Maersk, the big giant shipping company. They could not deliver their goods for weeks, I think. I think it was actually weeks. So a lot of other businesses suffered business interruption because they didn't have the goods from Maersk coming on board. IoT, I mean, we talked about medical devices, and not just like the Jeep getting hacked to the side of the road, but if you think about autonomous vehicles in general, once there's fleets of autonomous vehicles, if someone hacks into those, it could cause all sorts of havoc. that you don't know if it's going to cause bodily injury or physical damage or whatnot, but those are just some of the things that we're thinking about as an industry, is where could those, from a security and privacy standpoint, where can some of these claims go to? Marine's another one that is pretty interesting, where we've actually seen examples of pirates working with hackers, and they knew that there were cargo on the ship that had millions of dollars of diamonds in it, and they were able to steer the ship to the side, and the pirates came on board, or the pirates, or steer the ship wherever. It was off the course of the GPS, and the pirates came on board and actually stole some of that cargo. So those are just some examples that we're thinking about. Lou went into some of the other ones, like social engineering, where you have the CEO fraud scams, where you have somebody saying, oh, I'm the CEO, and it's not the CEO, it's some just sophisticated hacker that's emailing the CFO or somebody that has wire transfer capability, saying, oh, here's a confidential transaction, and wire X amount of money. And some of them are highly sophisticated, so sometimes we see those playing out. So we've seen that often. Do you have a question?
Yeah, I have a question. Has the industry coalesced around understanding what negligence looks like in this space?
Yes, so negligence that's an interesting topic. A lot of times what we've seen, these claims pay out, a lot of it is employee negligence, to be quite honest, and that's why some of the services, when Lou was going through the pre-event, post-event services, that really falls within the pre-event. We try to kind of be an end-to-end provider for the insureds, and a lot of times it's much better for the smaller insureds, because the larger insureds tend to be more sophisticated and already have some of these solutions in place because they're already partnered with various vendors. But we try to do employee training where we know that, okay, like some people don't understand if there's this cute video of a dancing cat, like don't click on it, it's like probably not a dancing cat, it's probably gonna infect your computer, like, but just showing like, okay, here's what a phishing scam looks like, or this is what the consequences of leaving your laptop in a taxi is. So we do provide that training because we've seen that that is really an issue where we've just seen negligence from employees. And also even talking about like physical documents. A lot of people think a cyber insurance policy would just really cover anything electronic. It also covers if you see like, a good example is like law firms where people will go dumpster diving. So law firms throw stuff out, they forget to shred it, and you have other law firms or whoever jumping in the dumpster to actually recover those physical files. So there are payouts for that as well. And then not just employee negligence, but you have to also really read your cyber policy, because all policies vary, but there's also malicious employee, where there could be malicious employee like insider coverage too, which we don't see those incidents as often, at least as an insurance carrier, but we definitely see a lot of negligence issues.
Yeah, I'm not talking about the employee.
Oh, I'm sorry.
I'm talking about the organization. They were aware of a risk. They didn't invest in it. You guys did some digging. You found that out. Have you figured out, has the industry figured out how that looks and how to dig into that to find some of those?
Yeah, so I mean, we were partnered with forensic firms, but we're also, there's been cases out there, and I can't really list them off the top of my head. I think Travelers had one, if I think about it, where if somebody fills out these applications and they fill it out improperly, I mean, sometimes it wouldn't be like on purpose that they say, oh yes, we're definitely fully encrypted and this and this and this, and then it turns out they weren't. We've seen cases where it said, okay, well, you misrepresented it on the application, so therefore we're not going to cover you. Is that what you mean?
Yeah.
Okay.
One example I think too is Equifax, where
where something was wrong.
You're not supposed to say that
there should have been
name.
patching done, there wasn't, right?
Yep.
And there's been some discussion around maybe down the road, and I think Ohio's getting to a point where they might be taking like a NIST standard, like if you have met this, right, then we won't consider you negligent, and maybe the policy will pay, and if you did not meet this standard, then maybe you won't pay because of negligence, right? So, but that is, nothing's in writing, it's more like just discussions. Right?
And carriers are also starting to use various underwriting tools that are a little more sophisticated than just here's a 10-page application that takes like between your chief information security officer, your CTO, your chief risk officer, like a number of parties to fill out. It's just kind of ridiculous. And if you only have one of those people filling out, then there's probably going to be misinformation, not on purpose, but just because they might not know the full story. So now we're partnered with a number of different tech vendors where we can actually go and do pen testing. A lot of outside in analysis to see, okay, well, instead of having a 10-page application, we could probably reduce this to 2 pages and get a lot of information from the outside that's probably more relevant and more reliable than just a human being filling out the form. So the insurance industry has been getting a lot more sophisticated in that sense, but it took a while to get to that level. And also you're thinking about a lot of the underwriters, I mean, since it's a fairly new area within insurance, a lot of the underwriters did not have a cybersecurity background. So a lot of them are really errors and omissions underwriters that were looking at, sometimes at least technology errors and omissions, so they had a little bit of understanding, but some of them were looking at like lawyers' errors and omissions or doctors or whatever kind of professional lines that person you might be dealing with and turning them into cyber underwriters. So what the industry has now learned is let's pull in people from the tech side, whether it's people working in the IT that's already at the insurance company, or let's pull in people from the tech industry to really be able to speak the same lingo as when we're in the room with a CISO, when we're underwriting an account, that we actually know what they're saying. Or we're trying to make sure that the underwriter are taking the proper security and privacy courses to get a good understanding too. Because it is, and that's one of the big issues, and I know that's a big issue in tech in general, there's just a shortage of talent right now, and that's especially for the insurance industry where cyber's just so, the cyber insurance realm is growing so rapidly, but the underwriters are not, because there's just not enough training going on and there's not enough experience that's out there because it's still a relatively new area of insurance. Does anybody else have a, yeah?
Yeah, so the risk seems really high, and it feels like you're providing homeowners insurance in a 100-year floodplain, right? Like big payout, big risk, and you're paying out a lot. Does Markel think this is a place to be for the insurance, or are you going to move into more of the mom and pops, like the chiropractors and the dentists?
So we do kind of all over the map. I mean, we support, and what Lou does is he does larger companies. When we were talking about that tower, the limits of insurance, we're typically playing higher up rather than being that one that if a claim comes in the door that's 10 million, it's not going to impact us because we're playing excess with like 60 million or something like that. For the larger, like Fortune 1000, we do provide primary insurance for the small to mid-size accounts. We're rolling out with the mom and pops pretty soon. One thing that we do look at, and which is part of my job, is to really understand the aggregation and what is the whole risk. I mean, think about common providers. If you have part of AWS go down and you're providing that contingent business interruption, it could be very systemic. So we don't want to overexpose Markel as a company, so we have to make sure that we're modeling to some of those scenarios. So when it said about flood, there's a lot of cyber modeling companies that are out there now. So some were traditional insurance modeling companies that would normally work with property insurance carriers that have now established cyber insurance models. And then you have some that are tech-driven, where one's CyberCube, which is a spin-off of Semantic. There's another one called Science that's out there that was recently purchased by Guidewire, where they're looking at various scenarios that they think could end up being systemic to a portfolio of these cyber insureds, to make sure that we're not overexposing ourselves, whether it's to a particular industry. And you can't really look geographically, like for property insurance, people think, okay, well, here's my Florida wind, meaning like Florida hurricane, or here's my California earthquake exposure. You can't really segregate that for cyber risk because it's global, the internet's global. So that's one area it's a lot harder to really get our arms around, to make sure that we're not overexposing ourselves. So we just have to make sure that we have the proper retentions in place, that any of those coverages that were listed in the earlier slides, that the ones that could potentially be systemic, where you might have multiple insurance policies hit, or multiple insurers that are buying cyber policies hit by the same attack, like a NotPetya, we have to make sure that we're not overexposed, which is very hard to do. And like if you think of common vulnerabilities, things like that, there's a lot of scary scenarios that are out there. So insurance is really trying to still get our arms around that. And we buy reinsurance as well, so there's insurance for insurance companies, which that gives us a little bit more assurance that if there was something that was large that were to happen, then we have insurance for ourselves as well.
Is that why the broker is building that tower out of multiple?
Yeah, because it'd be really difficult for an insurance carrier to take that, say Target, I'll go back to the $100 million example, it'd be hard for a carrier to take that $100 million on,
right,
because a lot of carriers don't even have $100 million in premium. So if they had, say they had $100 million in premium, they had Target for $100 million, and they had like one other policy for $50 million, they might have collected $10 million in premium,
Right.
and they're whipped, you know. So you have to just really manage what limits you have out there versus the premium coming the door. So you don't want to kind of put all your eggs in one basket and throw out huge limits. So
How does the broker manage that?
They don't care.
That's
Care
his
about you.
answer.
Yeah, they care about
I mean, the broker's really working on behalf of the insured. But I mean, it's really up to the carriers to making sure they're managing their capacity in a responsible way. And sometimes you will see a little bit pressure from the broker because that's their job.
So does
it's
the broker
really,
just basically say, yeah, how much can I buy?
Well,
How much can I get from you? And then they stack them from
yeah,
there?
I mean, normally you'll see, with some outliers, 10 to 15 million per insured.
Okay.
Right? Maybe even 20.
Right.
Right? But then there's different facilities that are in place with like an aggregate number of carriers that put up maybe 50 million, stuff like that. Again, if you have a broker that's worth his salt, that knows anything, he has a good idea how to get you what you need and at the right price.
One more question. Who are you typically selling to in terms of the role? Is it generally the CISO, or does it run the gambit, or?
It really, for larger companies, I mean, for the smaller mid-size, they likely might not even have a CISO, especially like mom and pops definitely don't. So
Yeah.
there, we're often trying to hold their hands to try to be value added to them to assist them. But otherwise, I mean,
Yeah.
if you have a big company, a lot of times you'll have
The risk manager.
the risk manager.
Risk manager is running the process. Like, all right, what do you, like, Markel, what do you need? Oh, we need a meeting. Who do you need there? And then we'll have like the CISO, maybe a few people in his organization who has the answers to the questions that we need, specific questions.
Right.
And then I'm sure they have internal discussions as to, hey, where are we okay losing, some, where we okay losing some data and then won't cost us as much. It's a whole sliding scale, like where you feel comfortable, how much is insurance going to cost versus how much it's going to cost us to have this issue. So the decision making usually with the risk manager at the larger risks, at the bigger company. Like Kara said, sometimes with the smaller companies, I would deal with like a CFO or the treasurer or someone who didn't want to talk to me.
Just one more slide and we'll take quick questions. I just want to go through this one because it's the most important slide within the deck. Not really, so I think I mentioned before that this coverage has been out since the late 90s. We actually found this, which this Shan Morahan on the right, that's a company that Markel acquired. And this is from 1982, and it was unauthorized computer access policy, which is essentially today's cyber policy. And we had this awesome actor that may or may not be a midget, and he has some very high-tech technology with that tape recorder there. So just thought I'd throw that in for a little bit of history on Markel.
So the insurance industry is as regulated as a 17th century waltz.
Yeah.
Where is the insurance industry regulation around all of this today? Because this is a whole new type of insurance. Even though
So there's a couple answers to that. So we do see a lot of the rating agencies and the regulators are asking a lot more questions around cyber insurance lately. The last five or more years, we're actually seeing them get a little bit more sophisticated and asking questions around that silent cyber component. So you're seeing a lot of carriers really try to evaluate, here's a marine policy, what do you think the cyber risk exposure could be in there and how are you addressing it? Because a lot of those policies, if it's silent in there, that means, potentially that full limit could be paid out and that underwriter was not contemplated. I guarantee you the underwriter on Merck where there's a property claim in for $1 billion, we're like, oh, maybe they'll not catch a massive ransomware attack that's going to cause a business. They weren't underwriting for that. They weren't charging for it. They weren't tracking for it. So the industry regulators are all really starting to get more knowledgeable around it. And then insurance as an industry has regulations with like New York DFS, like Department of Financial Services, and now the NAIC, which is the North American Insurance Commissioner or something. I should know that, but they've been starting to wake up to say, okay, well, insurance industry is holding sensitive data. We need to protect the consumer's data. So there are stiff regulations now over the last couple of years. Did that answer your question? A little bit?
It's similar like GDPR, from what I've heard from clients, made everyone stand up and be like, all right, I really got to figure out where all the data is and map it and see where everything is. They kind of wanted us to do the same thing. Like Tara said, it was like, they didn't want to walk in and be like, we might be covering, we might not, I don't know, maybe we're here, maybe we're there. That was a bad answer. Now the answer's gotten a lot better. Oh, here it is, this is how much we're supposed to, and here's a piece of paper to tell you about it.
Yeah, we just all know that the guys down in Capitol down the street, if, you know, you guys get hit with $100 million when you show up at your door, like, how come you didn't have the reserves?
Yeah, no. Oh, well, I mean, that's another thing, right? So that's part of your broker's responsibility to put you with insurers that even if they have a $100 million hit, they're gonna, you know,
They'll
they're
still
gonna
be
all right.
solvent.
Yeah, they'll still be solvent.
All right, I think we're actually out of time, but Lou and I can
Yeah.
take questions
Yeah.
in the back. Thank you all
Thank you
for
very
your
much.
time.